start. Colleen, show's yours.
Okay, our first topic is bond issue, and PFM is here to present. Garrett and Declan.
All right, well, it's a pleasure to be here. I don't know if you prefer me to come up to the table or just stand here. It's whatever you all prefer.
Well, if you don't mind.
Just
looking
hate
at the back,
speaking to
you
your
can stay where
back,
you
so maybe
are.
you might just come over here. That might be a little bit better.
That's great, Colin. Thank you.
Absolutely. So in front of you this morning is a presentation. So taking a step back, your administration had reached out to us to ask for some financing alternatives if you decided to finance the projects that are currently underway instead of using cash as you've done over the last several years to pay for these capital projects. In discussions, we understand the capital projects to be about $7.2 million that are currently kind of in the plans or underway. So that's really the message this morning is really to provide you with a couple options that you have at your disposal should you want to go the financing route as opposed to paying cash from it. Taking a step back and just to kind of refresh some folks, I know it's been a while since we've done financing with the district. So PFM Municipal Advisors are the municipal advisor to the district. So we're not a bank, we're not an underwriter, we're not a lender. Rather, our job is to act as your fiduciary should you decide to enter the capital markets to give you the breadth of options as far as financing vehicles go, discuss with you the pros and cons of each of them, and then based off of what is the best kind of tool in the toolbox for the district, we then go out and execute on your behalf to get you the best possible rate and the best possible terms that you can achieve in the market on it. In the past, the district has done a lot of bond issuances because you have a great credit rating, and we would assume you would still have that same credit rating, although you haven't entered the bond market for several years now. So walking through the presentation a little bit, page 2, my colleague Brad Remick, who's going to be here today but was unable to attend, always likes to say every good municipal advisor needs a colorful interest rate chart. So this is our colorful interest rate chart. I'm going to spend a few minutes talking about this. I'm going to talk really about the middle graph and the bottom graph. This is what we call the 10-year B-Val index, which is basically the tax-exempt equivalent, if you will, to the 10-year treasury. So I know a lot of us in our own personal lives look at the 10-year treasury as a barometer for the general interest rate market, for the broader market economy. We do the similar thing, but we look at the tax-exempt equivalent, which is what this is meant to show. And specifically, this is looking at the 10-year B-Val. So if you look in the middle chart, you can see going back to the early 1990s, we're at about historical averages. So we're certainly higher interest rates than what we were back in August of 2021, which were the all-time lows that the market has seen in its history. So we're certainly higher than we were compared to the all-time lows. However, when we look at things from a historical perspective, going back to the 90s, we're at about the historical average. About 50% of the time interest rates have been higher, 50% of the time interest rates have been lower. So this is really just to paint the picture that now is a fairly attractive time to be entering the capital markets should you opt to. Switching down to the bottom chart, you can see just over the past year, interest rates have been fluctuating. Specifically, you can see in April, in March of this past year, tensions in Iran caused interest rates to spike a little bit. And since then, we just heard over the weekend that there's a potential deal that's been signed or agreed to. So we're hoping that has an impact on interest rates as well, a downward impact. But I think what's important to illustrate is while you might be seeing mortgage rates and hearing about mortgage rates being in the 5.5%, 6.5% range, you all as a tax exempt issuer are not in that market. You guys are in the 3.5%, 4.5% interest rate market. So not saying that mortgage rates aren't where they are, but you all are in a different world, if you will, than mortgage rates being a tax exempt issuer. Jumping to page 3. Page 3 is a summary of the district's existing debt service to date. So testament to the district has over the years done a very good job managing its debt portfolio to the point where you only have one series of debt outstanding, those 2019 bonds. And those bonds pay off in fiscal year 2029. I think it's specifically September of 28. So you all have very minimal debt, less than $2 million outstanding, and it's very short. Again, 4 years, 3 years of remaining debt service outstanding. So again, testament to the district being able to manage and create a situation where you're looking to potentially be debt free in a few years, or potentially give us, the financing team, a method to take advantage and use some economies of scale to wrap around your existing debt service and keep it very affordable. I will only note that the difference between the top half and the bottom half, the top half is principal plus interest. The bottom half also takes into account the little bit of PlanCon reimbursement that you get from the state. So that's why we say the top half is debt service, principal, and interest. Bottom half we call local efforts of principal plus interest less your PlanCon reimbursement. So that's the difference between the top half and bottom. Any questions on that?
So I'm not sure I understand. You're saying the bottom half, it's a reimbursement, it's less.
Correct.
So a reimbursement from
The
whom?
state,
State.
the Commonwealth of Pennsylvania, through the PlanCon process that's currently in moratorium. But these 2019 bonds date back to 2014 and before 2014. So in those years, when you would do new construction or additions, basically if you were adding to the square footage of a facility and adding the square footage for educational purposes, spaces, you would get a percentage reimbursement from the state for your debt service. So if you look down at the bottom, you see that PE percent that says 22.55%. That's your project eligibility. So you are getting the product of your PE percent multiplied by your CARF, which is set by the state every year. And that percentage, or that product, by multiplying the two, is the amount of reimbursement you get on your bonds. So, you're getting about, 10 cents on the dollar reimbursed from the state on those bonds.
But not right now.
Right.
No, you're still getting that reimbursement on those bonds, but any new projects.
We do still get reimbursement for
Right.
that.
But to your
But
point,
new, yeah, no more.
it's currently in moratorium. So any new projects that you're talking about, for example, right here, any new projects that you're talking about next year, and not to be Debbie Downer, presumably any time in the future will not receive any more reimbursement. They keep floating around the idea of bringing it back in some new way, shape, or form, but they've candidly been saying that for going on 10 years now, and I haven't seen anything.
So if we would do the wraparound, we got 4 years left of reimbursement. Do we
Correct.
still get that, or does the wraparound all come as new?
So the new that we're going to talk about here today, the new about $7.2 million, would not receive any reimbursement. So you'd still continue to get
from the.
Correct.
We still get what we've been getting.
So you're guaranteed to get that reimbursement through the maturity of these 2019 bonds. So as long as we're not touching the 2019 bonds, which again, we're not planning on it, you're still going to receive the exact same amount that you would have received last year, the year before, 10 years ago.
And I'm sure I know the answer, but I'll just ask it anyway. So the money that's coming back from the state is coming out of the state's education funding?
Correct.
In their budget, in their state budget?
Correct.
Okay.
It's coming from the PlanCon program. They have a line item in their budget. It might be fairly deep, but they still budget every year for the PlanCon payments that are due to the 250 plus districts.
Thank you.
Yes. Okay, jumping to page 4. I know there's a lot of words. I'm going to try and speed through this and keep it simple. Uncle Sam gives you all the benefit of being able to borrow on a tax exempt basis, right? Like any good gift, right? It comes with a few conditions, few terms of service, if you will. One of the conditions of being a tax exempt borrower is you need to have a reasonable expectation to spend 85% of the bond proceeds within 3 years. So, candidly, you guys are already shovels in the ground for the larger portions of these projects. So that's not a concern to the financing team, us, your financial advisor, that you meet that requirement. But again, since we're talking about tax exempt financings, we always like to bring that forward and just let you know that there are some rules that you need to abide by. And part of our responsibility as your financial advisor, and certainly the responsibility of your bond counsel would be to make sure that the district is in compliance with all these rules and that we're not running afoul of any sort of IRS or tax code requirements or rules. I'm going to jump down to number 6 then, this notion of bank qualified bonds. Again, speaking about IRS, the IRS has a carve out in the tax code that says if you're qualify as a small issuer, i.e. $10 million or yet less in a calendar year, the lender, the individual or the company that lends you money is able to write off a portion of the interest that they generate off of that loan from their taxes. So because they're able to basically write off a portion of the interest expense, they're willing to offer you all, the district, a slightly reduced rate, a lower interest rate. Similarly, we see that bank qualified loans and bonds typically have a shorter call feature or shorter repayment date than non-callable debt. So for example, in Pennsylvania, if we were to issue $10 million in $1, those bonds would be called non-callable, and they would come with anywhere from a 7 to 10 year call feature, meaning that you can't repay or prepay the loan for 7 to 10 years. If we issue $10 million, so $1 less, and we're able to deem the bonds bank qualified, then we, on average, get a 5-year call feature and slightly lower rates. So to the extent, issuers in the market are able to borrow on a bank qualified basis, it's behooving of districts and issuers to do so. Again, we're talking $7.2 million here, so that's kind of inevitably going to be bank qualified, but you're going to hear us talk about that term kind of throughout the presentation, throughout the financing, should you decide to move forward. So that's what we're referring to.
So just to recap on that real
Yes,
quick. So the banks get a reduced fee on their interest, correct? In other words, they get to write off some of their interest, and in turn that flows down to the borrowers, which would be us, which will probably see a reduced interest rate.
Correct.
Okay, thank you.
Yes, sir.
And did I understand you said something about the payback? Is there opportunity to pay back sooner if
Absolutely.
That's
5 years
possible.
instead of 10.
Exactly. So if we're issuing,
Yeah.
again, the plan is to issue a bank qualified bond. So if we're planning on it funding these $7.2 million projects,
Right.
that would be deemed bank qualified, and there'd be a 5-year prepayment provision. So after the 5th year anniversary of the bonds, then you would be able to refinance it, similar to refinancing your mortgage if interest rates made sense and you could generate savings. Or if you decided at that point, gee, we had a large developer or something come in, now we have this windfall of cash, we could then pay off the
Pay
debt.
it off with no penalty.
Correct.
But if it would be prior to that, there would be fees?
There could be.
Okay.
It starts getting into the, instead of bonds 101, it starts getting into the bonds 102 or 201 level.
Hmm.
But you would still have the ability to prepay the bonds, but you basically have to take the money, place it in an escrow, and that escrow can earn interest. It can be invested
Okay.
until that 5-year call date.
Hmm.
So we call it in our world an economic defeasance. So it can still be accomplished, but it comes with a few extra hoops that we need to jump through, but it can still be done.
Okay. Okay.
So the last point on this page I'll note is the reimbursement resolution. So we recommend always when you're going through capital projects to have a reimbursement resolution put in place. Reimbursement resolution is typically a 1, maybe 2-page document, and it just gives you all the opportunity, but not the obligation, to reimburse yourself for any general fund expenses you've made as it relates to the project. So right now we're already shovels in the ground for a lot of these projects, and you've been paying out of pocket to get the work done, to keep the work going. The reimbursement resolution allows you to reimburse yourself out of a future loan for those expended funds.
Back.
Yeah, for those outflows, those capital outflows. It doesn't obligate you to do so. It just gives you the option, should you want to reimburse yourself to do so. I always equate it to an insurance policy. It doesn't cost you anything to, adopt, or it's not an insurance policy that you're purchasing. It's simply a resolution you pass. And if you choose to in the future reimburse yourself, you have that option to do so, but it doesn't obligate you to do that.
How far back? Can you go?
90 days from the adoption date, and then about 18 months going forward.
So,
So if we were to adopt
year
it,
and a half.
yeah, so if we were to adopt it, actually, we flip to page 5 real quick. We just have a sample timeline. So if you were to act on a reimbursement resolution at your board meeting on the 17th, so on Wednesday, you could then look back for all expenses made for the last 3 months, 90 days.
And what's the 18 months? What did that have to do? Or the-
That's it going forward. So for whatever reason, not all of these, because there's a number of different projects that are comprised of that 7.2. So
Right.
the big ones are happening now, but if there are some smaller projects that happen a month from now, 2 months from now, 10 months from now, you can still reimburse yourself if you'd like to.
Oh,
Out of that bond issue.
Exactly.
okay. Gotcha.
Again, if we have the funding in place, quote unquote, now, then there wouldn't be a strict need to reimburse yourself, but it gives you the option.
So the sewage plant, we've been over 2 years, second year into that. So we could,
Do a look back 90 days from the time of issuance of
do we
bond.
have anything, we do, work going on this summer.
Because it's on, yeah, it's ongoing.
So that would qualify.
And the reimbursement resolution is also a lot of times for, not a lot of times, it's really for, let's call it hard construction costs. You are able to reimburse yourself for some of the smaller soft costs related to a project. I always need to consult with bond counsel, but a lot of times your design, some sort of, sometimes like traffic studies, things of that nature can inherently be reimbursed without a reimbursement resolution. But certainly if we have hard costs that are going out, then we need a reimbursement resolution in place to reimburse ourselves for those. So I bring that up to mention that, to note that you have 90 days to look back, but certain costs that might have been incurred outside of that 90 days may still be eligible for reimbursement, depending on what type of cost they were. So again, it just gives you the flexibility. So
Sure, go right ahead. Cora.
For Amanda Springfield Township. So you're saying 90, so if we do the resolution, it looks like we would vote on that August 19th. Is that what I'm seeing?
no, that's a different resolution. Well, the timeline that we have listed on page 5 shows the reimbursement resolution occurring this Wednesday on the 17th, June 17th.
Oh, that is this meeting.
Yes, ma'am.
Okay. So it would be 90 days prior to Wednesday.
Yes, ma'am. So you'd be looking like mid-March.
Okay. So anything that we have already expended could be counted
Correct.
and possibly further back,
Correct.
but we don't know that for sure.
It just depends on what the actual costs prior to the 90 days were in relation to. So again, if it's like design costs, those typically don't need to be captured under a reimbursement resolution. But if it's excavation or earth moving or purchasing the sewer treatment plant, if it's, purchasing pipes or generators or things of that nature, those typically need the reimbursement resolution to be captured.
And it's when we would pay for them, not when we order them.
Correct. It's when the cost is incurred.
Yes, ma'am.
I just have a quick question. It's just a clarification. Going back, when you talk about wraparound bonds, we're not talking about taking the 2 million and adding that into the current bond issuance that you're speaking of. Can you explain that?
Hold that thought. We've got 2 pages on it.
Got it. Thank you.
Absolutely. Anything else? Page 5 has a high-level timeline. It also has this notion of a parameters resolution. So the district in the past has done this. Most of the districts in Pennsylvania do this. If you're thinking about entering the bond market for capital projects, what most districts do and what we recommend is this notion of a parameters resolution. Think of it as a resolution that sets the framework, the terms, if you will, of the bonds. And once those parameters are set, the financing team can then go and enter the market at the most opportune time. So why is that important? We've all, I think, collectively seen that there's some volatility in the market over the last month, year, what have you. Absent of parameters resolution, we would only be able to enter the bond market and price the bonds, price meaning locking in the interest rates, on a board meeting date. Knowing that most boards, only meet once a month, and sometimes they take off in June or July for the summer vacation, that pigeonholes us to one day a month to price the bonds and lock in those interest rates. And if we see on that particular day a lot of interest rate volatility, we've got two options. We either price the bonds anyway and just take what the market gives us, or we wait to the next month to price the bonds. Not saying that there's anything wrong with either of those two options, but the parameters resolution gives us the opportunity to, once you all adopt that resolution and give the financing team the framework that we have to work within, it gives us the opportunity on your behalf to enter the market when interest rates are most advantageous. So the framework being the maximum principal rate, the maximum borrowing rate, maximum interest rate that you all are willing to accept, and the term, the final maturity. So you set that framework, and then we, on your behalf, as your fiduciary, enter the market at the most opportune time, and then consult with your administration to make sure that they are in fact okay with the results. And then once we get the approval from the administration, then the interest rates are locked in. So it's not the district writing a blank check or anything like that. There are definitely checks and balances that we need to. High level timeline. We're here tonight, this morning, to give you a couple options as far as the financing. We'd be looking at your June 17th meeting for potential consideration of the reimbursement resolution. Also a potential authorization for us, the financing team, to proceed, i.e. start getting the ball rolling with getting a credit rating, drafting the preliminary official statement, which is the offering document, get the ball rolling on some of those administrative processes so that we would be in a position at your August 19th meeting to have the board consider the parameters resolution. Should the board act favorably on that parameters resolution, we would then be looking to lock in the interest rates in September and then have the funds available to you all in October. So from the time you price the bonds to the time you settle is about a month, just because we have to go through all the state processes to get the state approval. Any questions on any of that before we start finally talking about some numbers?
Just a note of clarification. So even though the potential locking in of rates would not be until September, because let's say if the board would approve the resolution for the reimbursement on the 17th, that 90 days goes back from there.
Exactly.
Okay.
It's from the date the resolution
The resolution is adopted.
not when the bonds are priced, when you get the money or anything like that.
Okay.
When the resolution is adopted. It's a great point. So finally, some numbers. So page 6, we have two scenarios. Both of them are wraparound debt service. Both of them are the same $7.2 million. But scenario 1 that we're showing on page 6 has the use of some district reserves to phase in the debt. So we're going to start from the left and move to the right. So columns 2 and 3, those are the district's existing debt service payments that we saw on the previous page. So about $630,000, $640,000 a year. Column 4 is the estimated debt service that we would attribute to this loan, this proposed 2026 financing for $7.2 million. So you can see it starts off at about $174,000 and $350,000. And then when your existing debt pays off in column 3, you see those repayments ramp up to be closer to $640,000. So that's what we call the wraparound structure, meaning that we're intentionally deferring some of the principal repayment until your existing debt pays off. And then once it does, we ramp up the principal repayment. And the reason we do that is it provides you the most budgetary relief. If we were to just amortize it like a 20-year mortgage or a 30-year mortgage, you would see a greater impact to the current year and next year's budget than if we utilize this wraparound structure. So this wraparound structure is intentional because it mitigates the budgetary impact. So you take column 3, you add in column 4, and then what we're doing is we're using about 880,000 of district reserves to bridge that gap between when we take on the loan and when your existing debt pays off. So that's what you see in column 5. So we're using about $350,000 in 2028 and $350,000 in 2029, such that when you get to column 6, you're left with the same debt service budget that you currently have. So put differently, you're able to borrow this $7.2 million, and absent some one-time use of cash to phase in the debt, you're able to keep your debt service budget the same as it currently is. Albeit, instead of paying off in 2029, it now pays off in 2045. So we're not touching the outstanding debt. We're not restructuring. We're not extending any debt. We're just utilizing this wraparound debt service structure and a little bit of existing reserves so that you can bridge yourself and you can continue to have the same debt service line item in your budget and get an additional 7.2 million for these guys. Any questions on that before I show you scenario 2, which is the same thing, just without the use of cash?
Your the current bond has an interest rate around 2.5.
Correct.
What are you guessing on these? 3.5?
Yeah, so for this one, for scenario 1, we're estimating about 3.8%. On the following scenario, because the following scenario is a little bit shorter, it's 12 years instead of 19 years. For scenario 2, we're estimating about 3.5%.
Thank you.
So scenario 1, on a nominal interest rate perspective, we're guessing to be about 1/3% more expensive. But what we'll talk about is what you're paying for. That extra 1/3% allows you to get that budget neutrality. So just to illustrate the point, page 7, same exact format, same exact financing, 7.2 million. But instead of using district cash in column 5, we now are amortizing the debt to truly kind of wrap around your debt so that when you end up in column 6, your payments are level at now $900,000. And that's just a product of, you take your existing debt of $640,000 in column 3, you add in the interest, the upfront interest expense of about $350,000. That leaves you with about $1 million in debt service, $650 plus $350, and then we were wrapping around that. The state requires you to have level or declining debt service, so we're wrapping around that new $900,000 number to keep it as short as possible. So while scenario 2 in the yellow is about $1.6 million more expensive or less expensive over the life, it does come with about a $400,000 budgetary impact. So when we're looking at numbers, it's always a balancing act, right? Scenario 1, more expensive over the life, but a lesser budgetary impact. Scenario 2, cheaper over the life, but a greater budgetary impact. We just have to weigh the pros and the cons of each.
And I'm sorry, the length of, it's 12 years for scenario 2?
Yes, ma'am.
And scenario 1 again?
Closer to 19 years.
So is there a reason why you didn't do the same term?
Just because we have that level in declining debt service requirement, so we decided to, because you would need to, in scenario 2, because you need to get your budget or identify basically $1 million in 2028 and 2029 for debt service, we just assume that wherever those funds were pulled from or whatever changes to the budget were made to afford that $1 million in debt service, we just assume that you would keep it there and continue to pay it at that level. And it keeps the debt shorter.
Okay.
Candidly, if you said, well, what if we just keep it the same length? So basically do scenario 1 just without the cash, then you can extrapolate the 2. In 2028 and 2029, there'd be $1 million debt service payment, and then it would drop down to the $640,000. or thereabouts. If that makes sense. We're happy to run the numbers and send it to you if you want to
Yeah, I'd like to
see
see
it
that.
black and white. Absolutely.
Yeah, absolutely. So, so what I'm trying to explain to myself here, instead of doing a wraparound.
Yep.
Let's pay two separate. So we have the first that exists that you have now,
Mhm.
keep that as is, and we'll start running the second debt.
So
And so, in other words, instead of doing a wraparound, just start paying this debt as we see it here without the reduced payments up front.
yeah, happy to.
Okay?
We're
Yeah,
happy
that'd
to.
be great.
Yeah.
Yep, thank you
And
much.
just for, again, if I wasn't clear, so we're not touching the 2018 or 2019 bonds. We're just issuing another. So when we say like new net, you'd still be paying on two loans.
Sure.
This would just be your aggregated amount that you see, one line item, if you will, debt service.
And I have one more question there
Yes,
for
sir.
you also. It's a fixed rate for the life of the loan?
Yes, sir.
Okay, thank you.
Good. I wanted to ask that
Oh,
too.
it's not individual. Oh, okay, that's confusing to me.
What
You
is-
say it's a fixed rate. I know in the past, the bonds that we've done,
It depends
each
if,
bond is a little, when you sell the bonds, it's not a big chunk unless you use the bank.
So that's
loan?
correct. So a little nuance. So it's a fixed rate in the sense that you're right. Each individual maturity has different interest rates assigned to each one, but those interest rates are locked in at the time of pricing.
Right.
So we say it's fixed rate because
Okay.
once we lock in the interest rates, we know what your debt service payments are
Yeah,
going to be
yeah.
through the maturity of the loan.
So most of the bonds actually mature every year, or every couple of years.
Yep. So
So
your
pay out,
Yep.
and some of them are at a lower rate than others, depending
Yep.
on the length of the.
Exactly.
term.
So
Okay.
for example, your bond that matures in 2029, that might have an interest rate of 2.5%. But your bond that matures at the very end in 2045, that might have an interest rate of 4%. So again, they're all fixed rates, but each individual maturity does have its own fixed interest rate.
And it's your job to make all those payments come out to the number on the
Yes,
last
sir.
column. Good.
Just because I like to learn from history, what, the 2019, how much did they borrow? What was that bond for? And do we know scenario?
So, yes, the 2019 bond was actually used to refinance the district's 2014 bonds. So the 19 bonds were a refinancing for debt servicing.
I know what we're doing now.
No, so what we're doing now is funding new
New
projects.
okay.
The 19 bonds, again, similar to when you refinance your mortgage. The interest rates in 2019 were lower than the interest rates in your 2014 bonds. So we refinanced the 14 bonds, got the lower interest rate, and in doing so generated
Couple hundred.
about $100,000 of savings for the district.
And what was that bond? How much?
That bond was for 4.4 million, round numbers.
4.4 million,
In
Yeah,
2019.
That's what we refinanced, but originally it was,
and that was what
I
was
wanna say
left over
12.
I was
from,
about to say, so not to go down the rabbit hole. So, and this just shows you why the shorter call feature is important. So those 14 bonds, those themselves are actually a refinancing of the 2007 bonds.
which was a higher interest rate back then.
Correct.
yeah,
So why that call feature is important is because it's with each financing, you get a new call feature. So in the case of, if you were to go back to 2007 when you issued those bonds have now been effectively refinanced twice for interest rate savings. Had we not done the bonds as bank qualified and gotten that 10-year call feature, we might have only been able to refinance them once. And depending on kind of the timing of how that all would have shaken out, maybe we would have refinanced them, maybe we wouldn't have.
Hmm.
I've been
So it
doing
was
this
not
for
gonna be
30
taken.
years. I
Good memory.
remember some of this.
So probably my colleague Brad, when he was here back in.
Hey,
2007,
I'm
less
ready.
gray hair, you know.
I'm still here.
Yeah.
I remember.
So we still don't know what it was for, though.
Well, it was for this building.
Renovations of the high
Yeah.
school.
Excuse me, do we have any more questions for the gentleman up here?
Renovations to the high school?
And Springfield.
The second, yeah.
Do you have anything else for us?
No, sir. I'm just here to answer any questions to the extent you have any remaining questions.
Do you have any questions for the gentleman here? I thank you very, very much for your
My
time.
pleasure. And
Yeah.
I'll get you those,
Yep,
that
great.
updated scenario, send it over and we'll get to you.
Thank you very much.
Yes, sir.
Yes.
May I ask you a question? I'm sorry, not of you, but of the board specifically, with regard to the amount of the bond,
Right.
that's being contemplated.
Yeah,
I'm not sure of the 7.2, how that number, I mean, I obviously have been a part of these conversations, but what's the
How'd they
reason
come up
with
with
the
7?
7.2?
That's part of all of our capital projects.
That's all of it
All of it.
that's proposed.
That's all.
So
of it
that's-
So there was
proposed.
conversation about taking part of it, for example, at one point in time in a fiscal meeting. I guess, are you committed to the 7.2 is my question?
Right. The lion's share is the auditorium next door
For
at
4.5.
Palms. Right. And then we have other projects that they're going to be rolling into it.
Right now, we're spending $1 million on the roof.
Right.
Good.
Treatment, demolition and installation of physical plant for the treatment plant, purple and gold gym replacement, backup, yeah, there's a bunch of things, auditorium renovation, HVAC control at Palms.
So I guess my question is, some of that we had proposed that it could be afforded with the fund balance that we currently have. So
Right.
Yes.
I'm just asking, 7.2 is the commitment.
Correct.
At this point.
Thank you.
Thank you very, very much.
Thank
We
you
appreciate the
all.
presentation. It was very clear and concise.
Thank you. Appreciate your time.
Yeah.
this
And you
morning.
can tell Brad, we're gonna hold his throat.
Hey, I'll be right there with you.
Okay.
I appreciate your time and everyone enjoy the day.
Thank you.
I mean, do we want to ask the committee, for their action to move to the board to authorize its proper officers? And consultants to prepare for a bond issue, including adoption
Those two
of a tax
things on the
reimbursement.
17th.
Yeah,
Would you like to
yeah,
move?
yes, and we're also waiting some information from the gentleman that we requested as well. So I would like to see that. I want to see the numbers where we're not doing a wraparound.
Okay,
Absolutely want to see those numbers and hopefully he can get those to us sooner than later. I believe he said he might have had them, but he just needs to send them out.
okay,
Okay?
sounds good.
You
So-
good with that, Joe?
So no recommendation?
You're talking about having something on the agenda for this Wednesday.
Yeah, I do.
Okay.
Absolutely, because
recommendation.
before, by the time the issuance is done, we're already in the fall.
Mhm.
Yep. And if I'm not mistaken, they're gonna be breaking ground across the street here.
Well, they're already working on
There you
that.
go. See, there you have it. Okay, thank you much.
Thanks.
Yeah,
Here,
absolutely.
next,
Thank you for that.
topic is, healthcare update, and Dina and Dennis are here to fill us
hey.
in.
How are you guys?
Morning, Dennis.
How are you? If you haven't, I believe when I look at the agenda, you have the pro forma on there. I'd like you to take a look at, I always look at, the first thing I look at is, our, on the bottom left, current fund balance. Our current fund balance is a healthy $1.3 million.
It sure is.
Good job.
That I know you as a board have worked hard and, myself, have tried to, we made some changes that have helped quite a bit. We still have 3 months to go in this year, but things are trending, looking very good for this year. If you look at the pro forma, you look at the net change in fund balance up at the top, it's B, C, D, E, F, and G. You'll notice that we always have a couple tough months in the summer. The stop loss packet kicked in right away for some of the high claimants. It could be 2-3 months, and then it starts to even out, and we start to build to that fund balance. So when we come back in the fall, we might have some negative news, but it's not news to panic about. It usually works itself out. A few things I do want to mention, looking at this as well. There is some talk about changing the stop loss. Currently, we're at a $75,000 stop loss. Right? And
I think that was decided not to do.
they did
Yeah,
at the last one.
Yes.
So that
Yeah.
was decided not.
not to do.
They're not
Sorry,
doing- They might do it in a future year, but not this.
not now.
Not this coming year. So
So
we're still.
scratch that.
Never mind.
All right. So we're going to be good for next year. The way we have it set up, that's 75,000. Everything looks pretty good at this point when it comes to that. Problem though is with the stop loss overall for the entire consortium. There is a problem because it was underfunded. All right. So what that means is at the end of June, when everything's reconciled, there may be coming back to each entity a portion of that stop loss that would be responsible for. This had happened in the past. Last year. But I don't think it's going to affect our fund balance that much.
0.1 is what they're saying probably will come from our 1.45. They're expecting 0.1 would be the amount that would be affected. It's about $2 million.
Aggregate for all.
For all.
And last year, if I'm not mistaken, our portion was approximately 100,000 plus or minus. It was something like that. Okay,
Yeah, it was, or a little under, I thought.
right,
Yeah, something like that. So they're probably about the same, I would think.
okay.
Pretty close. But if we look at where we're at, we're still in a pretty good position right now. So,
Mhm.
and we want to be at 2 months, in our fund balance. We're there.
We're at 2.6, we're great.
Yeah, we're doing pretty
Yeah.
well. Yeah, so hopefully that continues through next year. And, you know, if you look at the high claimants though, we do have quite a few high claimants here. So, and that continues to be a driving factor in rates and, you know, what our fund balance is. But right now, compared to previous years, we're in what I consider to be a pretty good shape.
I have a quick question for you.
Sure.
With the rollout of the new insurance packages.
Yes.
Any feedback on that? Did you hear it?
We had a successful open enrollment.
Okay.
We only had 4 employees that chose that plan district-wide. So,
OC4? Okay,
yeah, that's, I think they were probably all professional staff
okay.
that accepted that. So
They had 4 takers,
that's where we're at this
right?
year.
Out of a pool of how many?
What do we have, about 275, something like that, I'm gonna say.
Less than half of 1%.
Oh,
Got it.
yeah,
Okay.
it was small, and I
Yeah.
think we expected that, but we'll see what next year brings.
Okay,
A lot of people moved into the OC3, which we were happy about, so,
do you have a percentage on that, Dina, with the numbers on that?
I have numbers.
Yeah,
So
great.
For people who moved from the OC1
Uh-huh.
to OC2 was 34 people.
For a total of?
34 people.
No. You said 34 people moved, but you just had a total of 34 overall?
Oh, no, I'm sorry. I don't have the total of what's in each of those plans. I just have the
Ah.
numbers of what our changes were
Okay.
right now, but I can get those.
Yeah, that'd be
numbers
great. I'm just
updated.
curious, just the
Sure.
migration. I'd like to see the before and after
Sure.
and see how it's affecting people and,
I
you
can
know,
get that together.
yeah, they're
for
thinking
you.
with their budgets, right? And so, and the health of their family.
Yeah. The only other thing that I would mention here is, there is a possibility, and this is very unlikely, that St. Luke's Hospital will be coming out of network hospital for us. So, yeah. So I'm just telling you that because notices are gonna probably go out next month, and that's premature. But just so you know, it's there, probably not going to happen. This has happened before where there's been these threats, and it comes from the hospital. It doesn't come from Aetna. It comes from the hospital that's looking to negotiate. But again, notices will go out to all of our staff and they'll be you know.
Well, you two will have to go down there with a basket of some sort and, talk to the director and see what's going on.
This will be a big deal, is that word?
Yeah, it will be.
So,
It absolutely will be.
consortium will put a lot of pressure on that.
Right,
at
good.
that point. So, and it's happened before. It happened with Lehigh Valley Hospital.
A couple years ago,
Yeah, it wasn't that long ago.
Right.
And, again, they seem to work it themselves out at the end, but sometimes it takes until the last minute and in ways the hospitals fire up, people to complain to Aetna. They send out these notices to everyone that you're not going to be accepted. It's a bargaining ploy that they.
I'm sure of it.
So, I'm not worried about it right now. But as soon as those notices come
I'm
out,
worried about the letters, yeah.
then I'll get calls, get calls, and it'll create a problem. So we'll have to say, relax, we'll relax.
Mhm.
So that'll be a
And
problem.
they're aware, we sent notice out before everybody left for the summer, so they're aware that it's on the table, so hopefully that, calms everybody down, but it's out.
And I'd just like to add one more thing to the open enrollment. We have really successfully moved from what I call the traditional blues we talked about, where people were stuck in that you need this best healthcare plan. That a lot of people are now out of that mindset and moving into the idea of some sort of co-share with their healthcare and deductibles, things like that, and they're willing to accept them, and they're seeing the benefits of that. So we're changing the mindset.
Yeah, we also used a new tool this year that people could use to see what maybe the best plan is for them. Not a lot of usage this year, and we'll see what the consortium wants to offer it again next year. But it was used.
So it was if not mistaken, when you explained it before, it was an online pricing tool. They can plug and play.
You could put in, what do you think your health is going to look like this year? What are your dependents?
Okay.
It asked a big range of questions.
Okay.
And then it would tell you, how much are you willing to pay out of pocket? And then it would give you what they thought the best plan would be for you.
So just out of curiosity, Dan, I think it's a great tool, and unfortunately, a lot of people don't use it. What percentage of people do you think did use that tool?
I had about 25
Okay.
use it.
Okay.
That told me they used it.
They told you that they used
Because I
it.
use it as an incentive. We have some wellness funds, so if they used it, they got a gift card for using it
Okay.
this year. Now maybe other people used it and just didn't tell me, but those are the people that reached out to me to tell me.
Good.
You did get one? Yeah.
I did
Michael
too.
always gets them.
So,
Get one.
so I'm
thought
just
the tool
curious,
was
when
helpful.
you're saying that you've had a lot, that you're changing the mindset and
Yeah.
stuff, are we gauging things? Because we had talked about the potential of trying to move into like a health savings opportunity, a health savings account. Is that anything that we're still looking to try to move towards?
It would be a consortium decision at that point. Right
Okay.
now, the plans that are offered, they're not HSA qualified. So
HFA, right? Is that what it's called?
HRA,
HRA?
Oh, HRA,
HRA, I believe.
okay,
Yeah, that's
health reimbursement.
account.
Yeah.
Where you
So,
would,
Okay.
where you, as a board, would offer.
yeah.
Hmm,
And there's some benefits to an HRA and there's some benefits to an HSA.
okay.
Now, do I see the consortium in the future offering a high deductible plan? Yes, I do. So, I don't know when, because we make so many switches right now.
Yeah, yeah.
But I'd
that's
say,
the future.
I'd say like the consortium has this plan of taking a look at their plans every 5 years or so. I would think, like a 5-year plan as to where we're at and we'll go with that. And an HSA would be a little more complicated because you'd have to include your drugs with it. Right now, it's just, they're kind of separated. You have your RX and you have your healthcare.
I didn't think that we're talking about though, as a committee, you had talked about maybe for that OC4,
Mhm.
including that, expense account, to
Yeah.
that deductibles.
Absolutely.
And that would be a decision that you would talk about.
Okay.
For next year.
Yeah.
So just real quick, if you don't mind explaining to us and the rest of the people in the audience, on the back page,
Okay.
okay, you have there the fund balance roll forward year to date. All right, and then you have the stop loss fund and claims to stop loss.
Okay. Which page are you on?
I have page 10.
Page 10?
Mhm.
Okay,
So you have to the right-hand column, beginning balance, premium to stop loss only July. And then we go to, letter A, you have 7.6 million. And then the next column over there is, claims to stop loss B. You have a negative amount of 6.45.
so. So, yeah, that's for the consortium as a whole. That slide that was in there, that's for the consortium as a whole.
Okay,
So
so just, I mean, when you see numbers like that, know that that's not our district.
that's not,
Okay, I
Yeah.
just want, because people
Yeah.
will look at this and say, oh my. And I just thank you for clarifying that for everybody, because that's not our district.
no.
I share that because you're looking at that too.
Oh, yeah, no, absolutely,
Yeah, yeah,
absolutely.
absolutely.
But I
yeah.
just want to make sure that everyone's aware of that.
Everyone is, yeah, definitely.
Okay, because it's, if you're not aware of it, you're gonna say, well, what's going on?
Right, and that's why I would look at page 27. That is our, the health of our district within the consortium.
Right,
And there's some things in there that, like the vision expense and different things that are constant. And then what I tend to look at is how we're doing with, stop loss with high claimants. And that's when I look at, 28, and I look to see how we're doing. You're always gonna have high claimants. What you really want though is them to be small. So right now we have 14. So
right,
we would like to have that in single. So,
right. Do we have any other questions for, our friends here? Thank you very much.
Thank you.
Have a great
Thank you.
summer. Have a
Yeah,
great
you
weekend.
too.
Beautiful week.
All right, take care.
Okay, our next, topic is, property and casualty insurance renewal. This is with, Willis. The budgeted amount is 274,000, and with the renewal, they came in at 268,000. So we do have a savings on, with the actual numbers that they came in with,
Okay,
so.
great. Any
Okay,
questions on that? Great.
So, we're gonna ask the board, to move the board to approve the property and casualty insurance renewal as per the attached.
Right.
Yep.
Yep.
Very good.
Absolutely.
Our next topic is, delinquent real estate tax collection. As you recall, we had, Bucks County Tax Claims Bureau come and present, and we also had Portnoy come and present. I know that it's the administration's recommendation to stay with Portnoy. They are very easy to work with. They've been with us for a really long time. Yeah. Any questions on
I
that?
have no questions. I recommend we stay with
Yeah, we're
Portnoy.
good with that.
Okay, very good.
Thank you very much.
Thank you. Our next topic is, to receive funds pursuant to state and federal programs and authorize expenditures. This is to receive our federal, funds, for Title I, II, and IV. And,
This,
yeah, this
we
is just so
we
that
just say
can-
yes and move forward.
we just say yes and move
Okay,
forward.
any questions, team? Okay, great.
Marie Colley is here if there were any questions from the board.
Thanks, Marie, for coming. It's just pretty cut and dry.
Yeah.
Yeah,
Appreciate you very much.
Okay, our next topic is, this is a yearly thing that we, transfer budgeted funds based upon adjustments, that the auditors make. So this is, yearly, and we just need permission to do that, so.
Please. I have no issue. Anyone else?
No.
Okay,
Okay, next one is same thing. It's a yearly, it's a yearly authorization for the board treasurer and the business administrator to issue checks during the next regular board meeting or meetings.
you already
Yeah.
have my signature.
Yeah.
Right.
Thank you. Okay, our next, topic is, this is a new contract. This is, Ever-Driven. They are a service, a transportation service that, other school districts are using. It's more of an Uber service that, I was talking to the other school districts that they use for, if we have like, say, a McKinney-Vento student and Craft can't get to that, because we're doing other runs. So this would be a perfect option. And there's no, it's as needed. So it's not that we would have to pay any kind of upfront fees or anything like that. So,
My question about this one here is, what would we use it for? And is it something that we already pay for Craft to do within our contract with them?
well, if Craft doesn't do it, they don't charge us for it. So if they can't do, say, a McKinney-Vento student, if, just because of timing, like they don't have, and usually those ones are pretty immediate. So this would be, another avenue that we could try, that, see if they're available, that we can use them to go pick up the student or bring the student home.
In what scenario would we use this to pick up a student?
For a McKinney-Vento student, so for a homeless student.
A homeless?
A homeless student. That's part of our town, our community.
So we might have a student with housing instability who lives or who's temporarily staying, let's say, as much as 45 minutes to an hour from here. For our busing service to send one full bus out there, take a driver out of the normal routine, becomes very difficult for Craft at times. And I know that they're offering scrambling to bring those McKinney-Vento housing instability students to school. My understanding is this would replace that. I guess I have a question. Would it be at a cheaper cost than Craft going out there to get that one student? Do we know that?
Well, it depends on where the child is. And then, mileage, they charge mileage and trip fee. So it would depend, on that.
Hold on. Homelessness is one example. What other examples would we use this service for?
We could use them for special ed need. We could use them for, maybe not a child that is severe needs, but maybe that has, is able to drive in a car, and we could use for that. This is just another option. I mean, it's,
I would like to see something more about cost comparisons before I'd sign, or I think I would bring it up to anything. I really want to see how this would actually benefit us as a district. I guess my third question is, do we have a high need for something like this?
I'm going to say I probably could have used them twice this year.
Okay. And I don't know how the, so you say it's like an Uber. So would be anyone that we don't know, they vetted through a system
Correct.
to pick up, right? Because that's what these people do. They'll vet a certain individual. Just brings more people from the outside in. I think we just need to have some more information in regards to what's going on with this.
So who would authorize the use of this? Would that come from you,
It would.
Colleen?
It
So
would.
if Kraft said they don't have availability, you would make the decision
Correct.
that this service is where you would turn to next.
Correct.
Okay, so this is not something that parents and students are aware of, and they can just contact Uber service
no.
and use this for whatever
No.
purposes. Okay,
No.
so that's one thing. Typically, we're talking like one student at a time.
Correct.
Wow, okay.
She
But
would
this-
probably work, I'm sorry, she probably would
Yeah.
work closely with Lou as well, because those
Okay.
students have
Yeah.
been
Those
recommended
would be the students.
for transportation under these certain categories or
Okay.
needs, would come through Lou to Colleen.
And that would be if we're dealing with special ed or homelessness, but there could be other things as well that are outside Lou's parameter. Let's say if someone broke a leg,
Correct. Correct.
okay? And so the parents can't bring them in, but our new Uber service would bring the child to school.
Correct.
Questions first over here, Cora?
First of all, a couple of, but first of all, I don't understand the homeless situation. If the student is an hour away, why would they be coming to our district? But that's probably a subject for another day. And, and the other thing would be, I think you asked if that would be, you answered the question that it would come through you. Nobody could call out and ask
Correct.
for this.
Correct.
But what are we doing now? I mean, like, what
Well-
have we, that would be my question. How is this been handled and what?
Well, we haven't, I mean, we weren't able to do it. So,
what
I mean-
happens with a student if you can't transfer, As Scott would say, we're not required to provide busing service. You know, that's not a requirement of the state. So I'm looking at it from that angle.
If we do
Well,
any
when
of
it's
them, we gotta
McKinney
do all of them.
Vento, you know, the other school district that they're residing in is required to do one of the runs, either the AM or PM. And we, being the homeschool, is required to do the other run. So if we don't have somebody, we may have to pay the other district to do both runs.
So we are transporting them one way or the other. Is
We
that what you're
are.
saying?
We are.
Okay, thank you.
My question just had to do with background checks. I see that it's noted here, but obviously clearance is the same as our bus drivers. Now we're putting a sole driver with a sole child, so
Correct.
making sure that we're following all of the guidelines that our current drivers need to follow. I don't see that here, you know, as
There's a
far
couple
as,
pages there.
Yeah.
I'm sorry.
There's a couple pages.
No,
Yeah, they-
I see that it's noted, but I'm not sure that it's the same as what we require for CREF is my point.
That would be, I would do it.
Right.
Do we have any other questions for Colleen?
Do we know how many other districts, you stated other districts are using it. Do we know how many other districts are using it?
I got the information from Bethlehem School District.
Bethlehem.
So I know that they're using it, and also Quakertown is using it.
Okay. And the fact that it is as needed. So if we'd enter this contract, there's no money paid until service is used.
Correct.
Okay. Okay.
Do we have an example of what the cost would be? And like, do they give it mileage or how is that?
They,
The
yeah, they
mileage.
do. It's a $40 per trip and then $2.75 per mile.
So our recommendation is to hold off for further information.
More comparison.
Thank you.
Sure, the
Do you want us to bring it back to the, some more information you want to?
Yeah, we'll get some more information. We'll
For next
look at
fiscal.
it. We'll do another dive again. We're in no hurry. It's
good.
summertime, right?
Yeah,
Yep.
Okay,
We got a
great.
little time.
Okay, our next topic
Chip will
is
hit
the
that
Tech
budget.
Pool Council renewal. This is something we do yearly.
I'm sorry, what was that, Colleen?
Tech Pool
Tech
Council.
Pool Council
Okay.
Solution Agreement.
Okay.
This is an agreement with our solicitor that allows us to get model policies, ask them questions regarding technology. And they also provide professional development a couple times in a year. They'll come out and talk to administrators, teachers, or whatever.
Yeah,
about
this is
technology issues.
recurring.
Yeah.
Yeah, absolutely. And it's CTCs and LSEAs. Okay. And it looks like I set forth number 4 here, $11,413.50 for the school year. Do we have a number, how much what was just last year out of curiosity? You know, I was gonna ask that, right?
It's $800.
Yeah, I think it's 800.
800 more than last year?
No, it's $800
Yeah, the
total.
next
Yeah,
number
I think
5
so.
breaks it down.
Oh, I'm sorry, wrong line. 880.
Yep.
Okay.
Is that something that the Bucks County IU like reviews every so often to
Yes.
see if there's, okay,
Mhm.
all right. So this one's a move on.
Yeah, approved.
Move to the board.
Yeah, move to the board. Thank you very much.
Okay, our next topic is emergency cost mobilization agreement. This is an agreement between Palisades and Craft for any natural disaster that may have been.
Right. And this is a yearly thing that we look at because we never know.
Correct.
Move to approve?
Yep.
Okay.
Okay, our next
Jim and
topic
Linda?
is,
This is actually a new one. That
Oh,
bus
this is
one
new.
is a new one.
This emergency bus mode?
Mhm. This is new. We've not done this before.
So in the past, how did we do, an EMA?
I think our municipalities have been working on expanding on their emergency management stuff.
Right,
And so I think this has probably come out of that, where we're going to also be looking at Springfield Elementary being used as a thing.
yes.
I think this is an expansion of just allowing us access to the busing for emergency situations.
That sound about all right?
that's
Okay,
correct.
yeah,
Yeah.
I have no issue with this. I know
Okay.
that, Nakamixon district, they're very big on the EM as well, so.
Yeah,
Just, and I know they work with the school here, if I'm not mistaken.
And this will also be a part of our emergency operations plan.
Okay, great.
Good.
Yeah, super. Good to have you see.
Okay, our next topic is, there's an update to the resolution number 7, homestead farmstead exclusion. This was just a rounding issue that we changed a couple of the exclusion numbers, but, yeah, that's it, just a rounding issue. So we needed to update that and have it go through the full board again.
And did we round up or down?
Down.
Okay, good.
Yeah, always better.
By how much, Dana?
Oh, I
I mean, Colleen, how much
It
did we
was
round
like
that?
39
$30,
cents.
yeah, okay, not 30,000? Okay, okay, great. Yeah, absolutely. Any members feedback on the board here? Okay, approved, thanks. On the agenda. Thank you.
The next topic is a BCIU agreement for PIM services. This is a renewal or extension. This attached is the 25-26. We don't have the new one yet, but we have, it's the same term, same, everything's the same. The only difference is the price is, goes to $447 per day.
As opposed to,
It's a
It
$22
is-
increase for
Right.
next year. It's only charged if that service is utilized for that
Right.
number of time. 1 day equals 7 hours. And we're asking for the renewal process for continuity of services for Kelly and her role. Last year she wasn't yet in place. And so using that service to help get us through all the data uploading throughout the summer, which is a heavy lift. We also have in there a contingency that so long as we give 30 days notice, we can break that contract at any time without any additional fees. So if Kelly's doing an amazing job. So if we feel that in 3 or 4 months, she's good to go, we send a notice to the IU, we're out of the contract and we're done. So it's just to provide that safety net for ensuring our data being uploaded is accurate.
Well, how much did we use Kelly this year? How much of her services were used?
Well, so Kelly's our Kelly.
I'm sorry, Kelly. Yeah, our Kelly.
Yes, our Kelly. So our Kelly
Our
is
Kelly,
is
the
in
artist.
her role. We've expanded the role. So now working with me, we now have taken on enrollment, residency, and attendance and a whole bunch of other areas. And so she's learning the PIMS process. And so the IU, our contact there, her name is Andrea. She's very supportive. I don't have a figure as to what that total has been that we've used. It's within the budget that we have. And I know that Kelly's very diligent about not using services if not necessary. So we're well within budget. And again, as I said, our plan is to only exercise this extension for a couple of months.
So it's when Kelly needs additional assistance that she has to reach out to the IU, and then at that point, it costs us $400 a day.
If it equals 7 hours, so they calculate the hours. up to-
Oh, it's prorated. So if you only need them for a little bit, they'll prorate that 400.
Correct.
Okay, thank you very much. Thank you very much, Dr. Don. I appreciate that.
Would you like to move forward with that?
Well, I'm
Would you
sorry.
like to move forward with that agreement?
Yes.
They say yes.
Great. Okay. Okay, our next topic is, budget transfers
Mhm.
and review of the financial reports.
Any questions, anything stick out,
Concerns?
smack you, Linda? You looked at there. We're still paying for that generator?
Yeah.
I'm serious now. I am just like fed up that we're still paying that amount for that generator and we cannot get that. I don't know, why are we dragging, excuse me, I can't say why Can we find out what is taking so long? We're going on a quite amount of time here to repair a generator, and it's just money that's we're not seeing what's going on there. I really want an answer to that. I don't understand
So
why
this is
this is repetitive month after month. We're going after 6 months now, at least. Actually, it went down when did it go down? November?
I think maybe even October.
October, yeah. So, right,
Talking
we're,
about the high school generator, or the Durham Knox generator.
I think it's
The-
the high school
the
one,
high
it's like
school
over
one, yeah.
9,000 a month, right?
right.
Yeah.
Yeah.
So it just.
Okay.
Yeah, absolutely. There's,
Al told me the parts just came in for
They
the
were,
high school
yeah, there were
generators.
some
Oh,
controls.
good.
right,
Finally.
okay, thank you.
Prior month expenditures to date. It looks like we're running a little below the average. Good. Charter school update, no changes. Right to know request.
Any,
Any
any questions on
that?
the right to know, slap you in the face type of questioning?
Nope.
Okay,
Economic update.
The one, the 519 is highlighted on mine. Is there any reason for that?
I'm sorry, which one are you talking about? The right to know?
519, the sunlight access, it's highlighted on mine on what I have here. I was just wondering, is there something we should look at? Anybody else have it highlighted?
I think what that is calling is that in order for to differentiate, but just to see, so
Oh,
there's a blank,
okay.
a purple,
A
a blank, the next
day,
movie.
yeah.
purple,
Okay,
just to show that they're different.
okay, thank you.
and we had no change in cyber,
No.
no change in brick and mortar. Our percentage right now is just a hair below 76%. Okay, comparison to the overall average, which is 78% based on the last 5 years.
And our last is economic update.
So if I could go back, I'm sorry. So one question, I did see in the financial report, on June 6th, or I'm sorry, June 3rd, that there was a payment to USA Today and it's listed for advertising costs. It's like 2,400. I'm just curious, we use them for advertising?
We
What was-
do. Oh, I thought Dina was still here. Can I check into that and get back to you?
Okay,
I'm not
just
positive
curious.
off the top of my head, but I will look into that.
Okay. That's it.
Do we have any other Yes, Dr. Bear.
Hi, good morning, everybody. I saw on the upcoming, personnel agenda for the board meeting on Wednesday that we are having another seasoned teacher who is retiring. So that I believe now is 3 teachers who would be at the top of the pay scale, who have retired. We're talking about a $7 million bond, $3 million for an auditorium. And yet we can't have an intervention position. And yet we have a schedule that we've approved for the middle school level that is going to have an intervention position during the day. We really need to have a new position there. I don't respectfully understand why that's not being brought to us, but I'm putting it forth to the fiscal committee and I'm putting it forth. I talk about it at EPS all the time. It is really something that we do.
Thank you for sharing, Dr. Bear. I'm sure we'll hear more of that on Wednesday. Thank
Jim,
you.
did you want to say something?
None.
Oh, all right. I thought you had your hand up.
He said instead of 3, it was 4 million.
Yeah.
Okay. Did
There you
you
have it.
really?
Yeah.
Oh,
Yeah.
there you go.
And that's all we have.
Anything for the greater good of the committee? Colleen, thank you so much. Great job today. Sue, good to see you.
You as
Very
well.
nice. And Gary, always nice to have your presence. You're like so rock solid over there. We appreciate that. You'll have a wonderful upcoming week. Enjoy the weather. We'll see you on Wednesday.
Yeah.
With this today,
Meeting adjourned?
I'm good with that.
Okay, good.